Hello friends, now we are going to start last topic of our learning module, working capital and liquidity management. Here we are going to discuss third learning outcome, describe issuers' objectives and compare method of managing working capital and liquidity. So we will be discussing various methods, policies of managing working capital which include aggressive, conservative and moderate policy. And then why we are following this policy, what are the objectives an enterprise want to achieve by following those objectives, that is what we are going to discuss. Before going for this, expectation is that everyone is now aware about cash conversion cycle, that is days of inventory on hand plus days of sales outstanding less days of payable outstanding. We know how to compare required rate of return versus the effective annual rate of discount foregone. We know about liquidity. What do we mean by liquidity? Is the ability to pay off the short-term obligations. And what are the measures of liquidity? That is, absolute measures are cash flow from operation, free cash flow for equity and debt, and last three relative measure, cash ratio, quick ratio and current ratio. So we have already done these topics in the last video. So now we are going ahead. That is, now first of all, we will define what is working capital and then various working capital policies. Two numerical questions we may get here, and two type of numerical questions we may get here, and one theoretical type of question where examiner may give us a situation of a particular enterprise and they may ask based on the characteristics of those situation, that situation, to identify what type of working capital policy organization is following. So let's start with today's work. First, what is working capital? What do we mean by working capital? The term include capital. What do we mean by capital? Capital means the amount invested by our investors. That is what capital represents. What do we mean by working capital? Working capital means the amount which is invested by investors for day-to-day working of an organization. So this represents the actual amount which is invested by investor. Generally, people say investment in current asset represent our working capital, your stock, debtors, receivables, these represent your working capital. No, working capital is the amount which got invested. It is represented by these assets. When we are having current assets of 1000 crores and we have short-term liabilities or current liabilities of let's say 300 crores. So 1000 crore minus 300 crore is the 700 crore is the working capital. What do we mean by this 700 crore? It represents that 700 crore is being invested by investors in these assets which will be used for our day-to-day working, that is your which are used or which generate cash for our day-to-day working, your inventory, your receivable, your prepaid expenses, through which you will be performing your primary activities of the business. So this amount can be classified in two ways based on value. Generally, people use two words. First, what is the total working capital and what is net working capital? So the first thing what we defined is your current asset minus current liability. 1000 crore is your current asset, 300 crore is your current liability. So net 700 crore was invested in the business. This 700 crore investment in the business is representing your total working capital. What is total working capital? Total working capital is your current asset minus current liabilities. Second, then what is net working capital? Net working capital is the current asset excluding what they want to exclude, cash and marketable securities. Because cash and marketable securities are not by themselves going to do production for us. Production activity is done with inventory. So cash and marketable securities is excluded in the current asset, and in current liability again they excluded short-term and current debt. Now short-term and current debt is excluded. There is a reason. Small story. two loans were taken 20 years back. Number one is your bank overdraft, which legally is for 1 year. It's a short-term credit provided by banks to business. And second is a term loan for factory building. Which loan legally, of course, overdraft is for 1 year and your term loan is for 20 years. Which loan will end first? Term loan will complete by 20 years for sure. But in case of bank overdraft, generally bank as well as business, both, that is borrowers, both wants to continue that relationship. So they roll over that relationship, that loan every year. So ultimately that loan, bank loan, that short-term debt is effectively going to run till your business is going to run. So in substance, your short-term loan, that bank overdraft or cash credit, which legally needs to be settled in 1 year because of this rollover thing, is actually in substance long-term, more long-term than term loan which we have taken for factory building construction of 20 years. So by going by substance over legal form, the phrase is substance over legal form, that short-term credit become actually the long-term finance. That is why they exclude here. We do not have that justification in our course, but the justification is generally this. What is NWC? NWC is your CA excluding your cash and marketable security, short-term marketable security, minus your current liability, which exclude again your short-term debt. So if we use the previous example, which we have used in the last video for calculation of quick ratio, current ratio and cash ratio, let's continue with the same example. So we have been provided with the balance sheet of XYZ Limited, rupees in millions. We have been given data for 2 years, 2025 and 2024. This is the first numerical question which we may get in the exam. To calculate TWC or NWC, we have been given 2 years data and now they are asking us to calculate TWC and NWC for both the years. So if we sum up these current assets for both the years, cash is going to be included in current asset, marketable security, receivable and prepaid account, all are your current assets. Current liability or accounts payable, accrued and outstanding expense and short-term bank loan, all are your current liability. So let's sum up the values. The first one is 200 plus 300 plus 400 is your 900 plus 500, 1450 current assets for year 2025. And for 2024, the value of current asset was 250 plus 350, 600 plus 450, 1050 plus 200, 1250, 1280. I think these numbers we have used in current ratio also. 1450, 1280, correct number. Current liabilities are 750 and your last year, that is 2024, it is 550. Same numbers we have used in the current ratio also. So what is your TWC? TWC in this case is 700 rupees, 700 million rupees, and in this case it is 30 and 730. So from 730 your working capital reduced to 700. This is the amount invested by investors in the business for day-to-day working. Now if I want to calculate NWC means your current asset excluding cash and marketable securities. So what are the current assets we have excluding your cash and current marketable security is excluding 500, it is 950. And here we are going to exclude 600 rupees, so it is 680. This is your CA for net working capital, and then current liability excluding short-term debt. Excluding short-term debt means we are going to ignore this 200 and 120. So we have current liability for NWC as 550 and here it is 430. So what is your NWC? NWC is equals to NWC in this case is equals to 400, and in this case it is 250. From 250 we are now up to 400 million rupees, correct? 430, correct? 600, 680, that is also correct. So 250, and this one is 950 minus 550, so it is again 400, correct? So from 250 the NWC increased to 400, whereas your TWC from 730 it reduced to 700. So can be it's not necessary that TWC should be increasing, so NWC should be increasing. So it depends on the numbers. It depends on the numbers, because your cash and marketable security earlier it was 600, now it is reducing to 500. That is why your current asset is going down, your overall and total working capital is going down, and you have increased your term loan, bank loan. That is why your current liability increased. That is why your TWC got decreased, but your actual NWC, which is actual amount invested in your these assets, inventory, your receivables, prepaid, is increasing from 250 to 400. So this is the first type of question which we may get, where they may ask us to find out what is TWC and what is NWC for the business. Next. Now, after defining working capital, so now we know that NWC means the net amount of investment in your inventories, your receivables, your prepaid expenses, net of your suppliers credit and trade credit, and your outstanding or accrued expenses. So this is the net amount invested in your actual operating cycle or your cash conversion cycle. When we want to manage this investment, first of all, what are the objectives, what are the activities, and what are the decisions? So three things we are going to discuss first before going for the policies. First, what are the objectives, what activities we want to do, and what decisions we will be required to make. So first, the objectives related to working capital and liquidity management. Here the question which we may get is, they may give the situation and ask us to identify what type of policy we are following. So, objectives. Number one, of course, from corporate finance point of view. Corporate finance point of view, the ultimate objective, whether it was capital budgeting, whether it is capital structure decisions, or your working capital management decisions, the ultimate objective we have to achieve is maximization of valuation of the firm. So here also the first objective is to maximize firm value. Overall valuation of the firm should increase. Number two, maintain ready access, because this year we are also covering liquidity. And liquidity means the ability to meet out the short-term obligations, payment obligations. So ready access to funds necessary for day-to-day operation and obligation to investor. So there should not be any cash shortage, because of which our operations may stop. So that is the second objective. First, the overall objective, maximizing the value of firm, and second is that the operation should run smoothly. Funds should be readily available for day-to-day working as well as the short-term obligations. Next, what activities we will be doing here? First, we will be managing our cash conversion cycle. So we will be managing cash conversion cycle. What do we mean by cash conversion cycle? It is DOH, days of inventory on hand, plus DSO, days of sales outstanding, and less days of payable outstanding. So if we want to, of course, the objective should be to reduce cash conversion cycle, because more amount invested in cash conversion cycle is going to reduce profitability. Why it is going to reduce profitability? Very simple example. Two companies, company M and company N, two firms, both start work with a total funds or total capital available, long-term funds available of 10 millions and 10 million. Now, if M decides to hold 4 million in working capital and N decides to hold only 2 million, The net funds available for fixed assets, long-term assets, will be here. In case of M, it is 6 million, and here it will be 8 million. So of course, from liquidity point of view, M is having higher liquidity and N is having low liquidity. But from profitability point of view, now only 6 million will be invested in fixed asset. That means your plant machinery and etc. long-term assets. So only 6 million will be used for production activity, because finally production is done by plant machinery. Let's take example. Let's say there are the one machine is equals to is going to cost 1 million. So M will be able to get 6 machines, whereas N will be able to get 8 machines. So N is going to have higher investment in fixed assets, so its production capacity will be higher. So ultimately production will be more, sales will be more, profitability will be higher. Whereas in case of N, it will be low. So there are two contradictory objectives now we are facing. Number one is liquidity management and second is profitability management. So working capital investment is more making a trade-off or balancing between these two objectives, liquidity versus profitability. So ultimately everyone wants to increase the value of firm, which will be increased by increasing the profitability. Of course, there should not be any cash shortage. Both, again, increasing the profitability should not be at the cost of cash insolvency. So we have to manage that thing by managing our cash conversion cycle, depend on the business model also and the situation of economy also. Second, estimating the requirement of liquidity, of course, how much liquidity is required for day-to-day operations and payment obligations, and minimizing any excess cash, because whatever cash we are going to hold, it is that holding itself is going to create a cost for us. Idle funds are not going to generate returns. So higher the amount of cash we are going to hold, less investment either in the business asset or other investment will going to reduce the overall return. So any excess cash holding should be reduced. So these are the activities which we are going to do, that is managing cash conversion cycle, managing liquidity requirement, and any excess cash should be immediately reinvested. Or if there are no reinvestment opportunity, you should be returning it back to the shareholder in the form of either dividend or go for the buyback of equity. So what decisions we will be required to make here? Two decisions to find out the optimum level of working capital in relation to revenue. Two decisions will be required. First of all, what amount we should be investing in the current assets, high amount or less amount, we should be M or N, the example what we have taken. It depends on the business cycle and the business situation, the economic situations also, boom, recession, etc. Number one, the quantum of amount to be invested in these current assets, and number two is the determination of composition of financing, whether we should be using short-term financing or long-term financing. Short-term financing or long-term financing, and in normal situation yield curve is upward sloping, that we have already understood from fixed income topic. So if yield curve is upward sloping, it means your short-term debt will have lower cost, whereas your long-term funds will have higher cost expectation. The investors will have higher expectation. So the cost will be also higher because they are facing more risk. Long-term is going to create extra risk for them. So here we will be making two decisions. First, quantum of asset, and number two, composition of liability. So both type of things we are going to manage here. We are going to decide here. When I say quantum of current asset, again current asset is further defined into two parts. Two classifications are there. Number one is permanent current asset and second is variable current asset. Now what do we mean by permanent current asset? If I draw a diagram in relation to time, the permanent current asset will be constant irrespective of the business situation. Boom, recession, normal situation, this level of inventory receivable, a particular level of inventory receivable or staff which we will be required every time, Every time, peak season, off peak season, this level of inventory will be always maintained. This level of a particular level of receivable will be always outstanding. That is called as permanent current assets. Base level of inventory. What is variable current asset? Of course, to maximize profit, we will be required to hold more inventory during peak seasons. So this variable current asset will go up and down from over the current permanent current asset depending on the situation of the market. During higher demand season, that is peak season, we will be maintaining extra level of inventory. There will be extra level of receivable which will be outstanding. So that extra, that additional part of investment in current asset is called as variable current asset. Of course, in peak season, it will be high, and in off-peak season, it will be low. PWC, permanent current asset, constant level. Variable up and down, depending on the situation. Number two, what are the choices for financing? Short-term and long-term debt. So, short-term sources and long-term sources. So, that's what the core area of working capital policies. Decide about your current asset level and decide about the financing. So we have three type of working capital policies where we are going to try to balance trade-off between the two competing objectives of profitability and liquidity. Number one, conservative working capital policy, second moderate, and third or matched, and third one is called as aggressive. So here they are going to give us certain characteristic and to find out what type of policy the business is following. So number one, conservative policy. Conservative policy, they are always afraid that there should not be a situation of crisis. So they will always try to maintain higher level of current assets. Short-term assets to sales ratio, the third part, short-term asset to sales ratio will be always higher. Which company was conservative in our example? M and N, of course, M. M is maintaining more working capital, means more investment in current assets. So it means M is following conservative working capital policy because they are maintaining more short-term asset in comparison to sales, same level of sales. Aggressive, they will roll over things, quickly turn around things. They will keep their credit period short for customers. They will hold lesser inventory in their hand so that more quickly that investment can be used. So they will be holding less current assets. Whereas in case of moderate or matched policy, they will be always somewhere in between these two extreme policies. Moderate level of current assets. Which type of financing these policy will be using? First, the conservative policy, working capital policy. Again, they are very afraid of short-term crisis. So they will be always rely more on long-term sources. Whereas aggressive wants to increase. Aggressive means they are okay with the risk to maximize profitability. And we now already know that the short-term rates will be generally lower than the long-term rates. So they will be relying on short-term financing, more on short-term financing to minimize their costs, maximize their profits. And moderate will always match the funding. When I say match the funding means what? We have already discussed two type of current assets. Permanent current asset, which though are current asset but will always stay in the business. Plant machinery is having a long-term life. So same characteristics is also followed by these permanent current asset, because that level of inventory will be always going to be rolled over. We are having 100 pieces, let's say it's a shirt retail outlet, we are maintaining an inventory of 500 shirts. So if 10 shirts are sold to customer, new 10 shirts will be placed on the racks. Anyway, we will be always maintaining that 500 level of inventory. So permanent current assets. Conservative will always go for long-term source. Of course, they are anyways relying more on long-term source. These are current assets, but by nature, in substance, they are long-term holding, long-term assets. So they should be financed by long-term source. Match case, again, they will be using, because they are going to match long-term assets with long-term liabilities. So they are following, they are going to use long-term source. Aggressive wants to maximize profit by using the source which is having lower cost. So what they are going to do, they are going to part fund your long-term permanent current assets with short-term sources and some part with the remaining part with the long-term sources. So part will be financed with long-term sources and remaining will be financed with short-term sources. Next, coming to variable current asset, that additional current asset which we will be holding to meet the peak season demands. So in that case, conservative, being conservative, wants to go, is a risk averse person. So they will always try to avoid obligation, short-term crisis, bring short-term obligation, bring short-term crisis. So they want to avoid short-term crisis, so they want to avoid short-term finance. Of course, this is going to hit their profitability also. Conservative, taking less risk, will get less rewards, less profits. So here, even variable current assets, they are financing part with long term and remaining with short term. Whereas aggressive, already working on short term finance for the permanent current assets. So for variable, they will be using short term sources and they are relying more on short term sources. Moderate, being moderate, they will match permanent with long term, so variable with short term. So these are the situation of level of assets and the sources of finance which these three type of policies will recommend. Next, now we will go in detail. What do we mean by conservative working capital policy? What do we mean by conservative working capital policy? More current asset in relation to sales, more relying on long-term sources of finance, even permanent current asset financed by long-term sources, even variable current assets, part being financed by long-term sources and remaining by short-term sources. Want to avoid short-term obligation crisis, so they are using more long-term finance. Of course, the returns will be low. So what are the characteristics of conservative working capital policy? Characteristic number one, more current assets, already discussed. More financial flexibility, because there is no day-to-day obligation which is coming to them, everyday obligation coming to them, because they are using long-term sources, and typically costliest. So flexibility is more because using long-term sources, but profitability will be lower because long-term sources are going to cost more. So profits will be lower. Reasons: early growth phase. In early growth phase, it is very difficult to raise finance for variable current asset easily from the market, because we are new to market. People will not be investing whenever we want. So generally, these type of companies raise long-term finance. So since they are having limited access to short-term finance, that is why they are using long-term sources. High profit margin firm able to pass on this higher financing cost. If you are in a monopoly situation and you can pass on your long-term financing higher cost to customers, then this type of policy can be used. Expectation of flat, this is important. Changes, it's based on, it's not existing situation, it's based on the future situation. If in future we are expecting that interest rates will be rising, it's better to raise finance today at a lower rate, even for long term. So in case of flat to rising interest rate, very important characteristic, that if we are expecting that in future rates will rise, it's better to raise finance today on long term basis at a lower cost. And reduce need to access capital during market stress period, because we have already raised finance, we are already having finance for long term period. We need not to go for raising finance even in the stress situation. We are already having excess finance. Pros and cons: advantage, disadvantage. Advantage, flexibility will be there. Disadvantage, it's a costliest. Profitability will take a hit. Stable, permanent time finance available. No issue of rolling over the short-term finance. every year end your short-term debt holders are coming for repayment and we are negotiating again and again for next period. So that rollover, whether they will, and now they will decide whether to roll over or not. So that risk is not there. That uncertainty is not there. Financing cost is known upfront. We have raised long-term finance for 10 years. So that 10-year cost is already constant. We are certainty of working capital, need to purchase necessary inventory. There is no day-to-day issue of shortage of working capital finance. Higher flexibility. We want, whenever we want to increase inventory, we can increase. When we want to increase receivables, we can shift that finance to receivables also. So there is more flexibility. Cons, disadvantage, long-term debt have higher interest rate. If we are raising from equity, again, equity is the most costliest source. So again, high cost. Eliminate the opportunity to borrow only as needed. Since you have got the finance for 10 years, so even if you are not having additional demand of your product, still that finance will be there. You need to pay returns to investor and that finance is sitting idle in your business. So you are losing opportunity cost. Actually, it is going to create opportunity cost. More restrictive debt covenants. Since you are raising long-term source, you are using long-term source, long-term debt, they will place covenants which will restrict business activity. A longer lead time is often required to establish these finance position. Lead time is the time which is between the point of ordering and receiving the ordering. So here also a longer lead time is often required to establish these financing position, means where we will be negotiating with the suppliers also. So these are the advantages and disadvantages. Next, moderate or matched working capital policy characteristics. Moderate policy is financing is having matched level of current asset, moderate level of current asset, using both long-term and short-term sources, long-term for permanent current assets and short-term for variable current assets. So they are matching long-term with long-term, short-term with short-term, asset with liability. So balancing between, they are balancing between long-term finance for permanent current asset and short-term finance. Reasons, they can accurately forecast their level of current asset for permanent level and their variable level, and balance the use of less costly short-term source and certainty of permanent working capital. So they are trying to trade off, balance out the flexibility of long-term source with the benefit of or low cost of your short-term source. That is what they are trying to do. That is the reason for following this policy. Advantages of both sides: lower cost, lower rollover risk, and flexibility also. And you are using diversified source of finance, so there will be, and disciplined approach, so there will be less situation of crisis. Disadvantages: in case of stress period or seasonal or growth, to meet growth need, sometimes finance is not available. So because of market condition, we may face some problem at the time of peak season. If finance is not available due to shortage of finance in the market, supply restrictions, we will not be able to take advantage of that peak season. So that can be a problem. Uncertain cost of short-term debt, since you are using short-term debt for your variable current asset, so it may go up, it may go down, there will be uncertainty. Additional risk, moderate risk, I'll say. May have to rely more on costly trade credit to meet seasonal or growth demand. Same thing, if the finance is not available from short-term debt, we will be required to negotiate with our supplier who may raise prices for giving extra trade credit. So this may be again going to create a disadvantage for the company. So, but still these guys are going to trade off, and they will be following, enterprise will be following this policy only if they are good negotiators with the suppliers and they have good access to the short-term debt to meet the seasonal or peak time requirements. Aggressive working capital policy: less level of current asset, using more long-term financing sources, short-term financing sources, because they short-term financing sources are going to cost less. even for permanent current asset, some part will be financed with short-term sources. The objective is to maximize the profit and sacrificing the flexibility. So minimize excess current asset. It's not that reduce current assets to zero, minimize excess. Don't want to hold extra current assets. Reduce short-term flexibility. Yes, of course, it's going to reduce short-term flexibility because you are not holding, you are not getting finance for long-term period. And higher return to investor. Higher return to investor because less cost will be incurred on raising the finance. So more returns will be available for payment to final equity investor. Here we are talking about equity investor, residual receivers. So if less interest will be paid on debt, more amount will be available for equity holders. Reasons: low profit margin industry, they cannot afford to go for higher cost of debt. Ability to forecast future sales, only then you can reduce your current asset and cash need. Stable and falling interest rate. In conservative, it was a stable or flat or rising interest rate. Again, here we are talking about future interest rate. If we expect that in future interest rate will decrease, why to raise long-term debt at higher rate today? We will raise debt at future date whenever it is required, even at a shorter rate. So that can be the reason. Expectation that firm will shorten cash conversion cycle. If we can reduce the cash conversion or operating cycle, it will ultimately reduce the requirement of working capital. So why to go for excess capital procurement? An ability to quickly liquidate. You should be able to turn around your inventory or collect from your receivables. Then only this policy will be followed. Pros, advantages: lower cost, short-term debt is going to cost less. Flexibility to borrow as needed, whenever needed, but this is also going to create a risk also. Uncertainty of rollover risk. Fewer restrictions since you are not raising finance on long-term basis, so less covenants will be there. And flexibility to finance when rate decline, but it may go wrong or it may go reverse also. So next, interest expense may fluctuate. In peak time, stress situation, even the short-term debt will be going to be more costlier than the long-term debt. Rollover risk will be always there. More costly trade credit, even supplier will going to, when they will come to know that you are having shortage of finance, they are going to increase their rates for giving extra trade credit. So few disadvantages. So question may give situation and ask us to identify the policy. So these are the pointers which we should be taking care for identification of the policy. Next and the last topic is liquidity and short-term financing. Now here when I say liquidity, means ability to pay your short-term obligation through cash or using the marketable security, short-term marketable security. What objectives company wants to achieve? What type of strategy? This a prudent short-term financing strategy, that is availability of your finance, your cash. When to borrow and in what form, achieve several objectives. So how to create that liquidity, either holding the cash or going for short-term debt. What are the objectives? Maintain sufficient and diversified sources of credit to fund ongoing cash need. So we should be having more number of sources. So if one source is not available, we should be able to move to second source whenever there is a requirement. Securing adequate funding capacity to handle the firm changing cash need for peak, seasonal and planned growth. So we should be having always adequate fundings. Confirming financing rate offered are competitive. It's not that we should be paying more in comparison to our competitors because our liquidity or financing situation is in a trouble. So financing rate should be competitive. And last, ensure that both implicit and explicit funding cost are considered while doing this liquidity management. What do we mean by implicit? That is cost of discount foregone from supplier, that effective annual rate. So whenever you are doing this liquidity management thing, whether to pay or not pay to supplier, you should be considering both the effective annual rate of discount foregone versus your required rate of investment, required rate of investors for early payment and availing the discount. These should be considered. So in all, your liquidity management is more related to your cash management. whether you should, how much cash you should be holding, what sources you should be having multiple sources to raise cash at the time of requirement. The cost of raising that cash should not be non-competitive, and both this type of cost, implicit and explicit, should be considered when you are raising your short-term finance for your liquidity needs. Now, these short-term fundings will be depending on certain factors. What are the factors? And then we will go for a numerical question. What is the overall cost of raising the short-term liquidity? So, factors which will influence your short-term funding. Number one, size of the firm. Smaller firm will have lesser sources, whereas big firm will have access to capital market also. They can issue commercial papers in the market, short-term instrument, negotiable instrument, commercial paper in the market for raising the short-term debt. Whereas smaller firm may not be able to get the access to the capital market. So they may be dependent on your bank loan or your unsecured loan from known people. Creditworthiness. Creditworthiness, your rate as well as terms condition offered by lenders depend on the creditworthiness. Creditworthiness include both your ability to pay and your willingness to pay. So again, that is also going to impact your short-term funding requirement. Next, legal consideration. Economy having good legal system, there will be more sources available. Economy having less legal system or underdeveloped legal system, then lesser alternatives will be available because people will feel more risk for providing short-term fundings. Regulatory constraint. Some businesses, banking, your financial services, generally banking, your mutual fund industry, your insurance industry, they have certain regulatory requirement for raising the short-term finance. And last one is underlying asset, collateral to be provided for raising these assets. So all these 5 factors, first, size of the firm, creditworthiness, your asset, underlying asset, legal consideration and regulatory consideration, all will be factors, all these factors will be considered while raising the short-term fundings, whether to go for higher short-term funding or lower short-term funding. Now let's go for the cost of raising the short-term funding. XYZ need 1 million for payment of short-term obligations. So we need short-term funding. 3 options are there. Use long-term source of finance like equity or long-term debt. It should not be used because it is anyways going to cost more. And what will you do once the funding requirement is over? You cannot pay back again to your equity holder by going for buyback. There are certain rules. Every country has their rules for buyback, and once you have raised finance for 10 years, you cannot just after 2 years that now we don't need take it back. We cannot say. Generally, this will be avoided because of course the final cost will be higher. Next, delay payment to account payables by foregoing discount offered under credit term of 2/10 net 45. So first source, your accounts payable, what will be your cost of raising, delaying 1 million will be 2% discount you are foregoing over this 1 million. That is the loss of how much? 2% is equals to 20,000. Next, sell account receivable at a 10% discount. So it's not 10% of 1 million which you will be incurring here. In case of account receivables, the gross value discount will be applicable on gross value. So how much discount you will be incurred? It's the difference of the gross value of receivable and the net value, that is 1 million which we have received. So if receivables are being sold at 10% discount, so anyway this 1 million is equals to 90%. Account receivable, this is the cost. The value of receivables will be equals to 1 million is now equals to 90%. So the net value is equals to, gross value will be equals to divided by 0.9 is 1,111,111. It means the cost will be equals to 1,111,111 minus 1 million is equals to how much? 1,11,111. Next source, sell marketable security at a brokerage cost of 1%. So by raising finance using marketable security, the cost will be equals to 1%. Now you have to sell For net value of 1 million, so 1 million will cost you 1 million into 1%, that is again equals to 10,000. Which source will be the cheapest? Is this the third source is your cheapest source? You should be using the third source. So till with this learning module is over. Very easy topic. Last topic was more theoretical. 3 type of policies. They will give situation, identify the policy, and these 2 small numerical questions. The first one to calculate TWC and NWC, and second one to calculate the cost of raising the liquidity, short-term liquidity. With this, thank you so much. Have a good day.